It's recently traded into all-time record highs. But Gavin, the mining stocks are languishing. To look at an index of the mining stocks or some of the bellwether names in this sector, you would not guess that gold is trading at its highest price ever.
Absolutely, and it's a remarkable disconnect because normally gold miners are regarded as leveraged plays on the price of the metal, not necessarily financially leveraged, but operationally leveraged, because each dollar increase in the price of an ounce of gold, all other things being equal, will drop straight through to their bottom line. Yet we have gold, as you mentioned, at an all-time high, $2,200 an ounce, although actually, of course, if you were to adjust it for inflation, $850 40-odd years ago would be somewhere well north of $5,000 now. But nonetheless, in nominal terms, it's hitting new all-time highs. And yet the gold stocks sit there at a complete lack of interest. And this is, I think, a disconnect between the metal, where Asian buyers, particularly obviously China and India, but also, interestingly, central banks around the world, not merely Asian central banks, but countries like Russia or Poland or Hungary, are actually buying lots of gold as a diversifier for their international reserves. And yet the Western investor is completely disinterested. Money has been coming out of GDX, which is the major ETF which invests in gold miners. And yet, I say, the price of gold itself is hitting all-time highs. So as a result, gold stocks are as cheap as they've been relative to the metal probably for 20 years. The last time we were at the bottom of the last big gold bear market when it hit $250 an ounce, and Gordon Brown, the then Chancellor of the Exchequer in England, was busy selling most of the UK's gold reserves because it was an outdated barbarous relic. So it looks to be a very good opportunity to be buying. And in the meantime, would you believe, Paul, you're actually getting fairly decent dividends out of a lot of these large gold miners because they are concentrating on profitability, not on making overpriced acquisitions of other gold mines.
Skeptics would say, Gavin, that when an investor buys exposure to gold itself through perhaps an ETF, that investor doesn't have to deal with things like poor quarterly results, mergers and acquisitions that don't deliver shareholder value, troubles in political risk troubles in jurisdictions which the companies can't control. In other words, there's all kinds of ways that gold companies can put their foot in it and disappoint investors.
Absolutely, and that's one of the reasons why you probably want to have a well-diversified exposure in the gold sector. But the old rule of thumb for preservers of capital, people like the old Swiss private banks, was you should have between 5 and 10% of your total asset exposure in precious metals, because it was a diversifier. It was nobody else's liability, unlike fiat currencies printed by governments. And yes, you can buy the gold, but the good thing is if you're in a well-run gold mine in politically stable jurisdictions, a company like, for example, Agnico Eagle, which is the largest Canadian gold miner, has all its mines in Canada or Finland. I think they now have one in Australia as well because of the recent merger with part of Yamana's. Then you're actually fairly well insulated from the political risk. And secondly, you've got a management with a demonstrated track record of delivering value. But if you're also a diversified miner, like, for example, the gold royalty company Franco-Nevada, which its largest royalty is the one on the copper mine in Panama, Cobre Panama, which, of course, the Panamanian government, in its infinite wisdom, has decided to close down. There goes 5% of the country's GDP, but do not worry. You actually have a whole bunch of other royalties diversified geographically and even by metal, for example, which enables you to actually ride out some of these bumps. I think the feeling is that the fall in Franco-Nevada's share price since the Cobre Panama situation blew up is about 3 times its contribution to Franco-Nevada's profits in the last full year it was running properly. So if you're actually able to be in a well-diversified company with good management, you'll do pretty well. And I think, for example, Franco-Nevada is up something like 10 times since it went public, relisted 15 years ago, while the price of gold isn't, maybe it's gone up 50% in that period.
Gavin Graham is our